The subcommittee will now come to order. The chair recognizes Mr. Vallandigham for the purposes of giving an opening statement.
Thank you. Chairman Capito, Ranking Member Meeks, and members of the subcommittee, I am Samuel Vallandigham, President and CEO of the First State Bank, a $270 million community bank in Barbersville, West Virginia. I am pleased to be here on behalf of the more than 6,500 community banks represented by the Independent Community Bankers of America. I will focus my testimony on 3 bills before this committee that are of particular interest to community bankers: the Community Bank Mortgage Servicing Asset Capital Requirements Study Act, the End Operation Choke Point Act, and the discussion draft, the Access to Affordable Mortgages Act. The common theme of these bills is government overreach, whether it's in the form of arbitrary capital requirements, law enforcement abuse, and examination practices that harm legal and legitimate customers, or rigid and expensive appraisal requirements that escalate the cost of mortgage credit. ICBA is grateful to Representative Luke Meyer for introducing these bills. The first bill, H.R. 4042, would delay the effective date of the Basel III Mortgage Servicing Asset, or MSA, provisions for non-systemic banking institutions and mandate a joint agency study of the appropriate capital treatment of MSAs. Community bank mortgage servicing is at risk due to the punitive new capital provisions of Basel III. Banks that have strong capital ratios today and that have serviced mortgages for decades without problems would have starkly lower capital ratios under the new rule. My bank would lose over $1.6 million in common Tier 1 equity, reducing our Tier 1 ratio by 50 basis points. The capital reduction, combined with higher risk weighting of MSAs, would reduce our risk-based capital ratio by 95 basis points. This impact would force me to fundamentally change my business model. The Basel III rule is in fact increasing systemic risk, the opposite of its intended effect. A high volume of MSAs is shifting from regulated bank servicers to the shadow banking system. Non-bank servicers are not subject to prudential standards such as capital, liquidity, or risk management oversight. FSOC and Comptroller Thomas Curry have expressed serious concerns about the impact of this trend on financial stability. Community banks are best qualified to service the loans they originate and have done so without problems for decades. The study mandated by H.R. 4042 would provide information that is critical for the design of appropriate rule. We urge its expeditious consideration by this committee. The second bill, 4986, would preserve the ability of banks to serve legal and legitimate business customers without undue pressure from law enforcement or examiners. H.R. 4986 is a response to Justice Department's Operation Choke Point, which is pressuring community banks to sever relationships with long-term customers in legal and legitimate businesses. Choke Point has quickly become a threat to the free exercise of commerce and the rule of law. Community banks currently dedicate significant energy and resources to monitoring, detecting, and reporting of fraud and other financial crimes in compliance with the Bank Secrecy Act. Banks are eager to cooperate with law enforcement, but we cannot and should not act as police. At the same time, bank regulators have been scrutinizing bank relationships with businesses deemed high risk or that supposedly create reputational risk. We are grateful to Chairman Hensarling for addressing this issue in a recent letter to the banking agencies. It is beyond the scope of the supervisory process to assess a bank's reputational risk or to prohibit or discourage banks from serving legal customers. Community banks are the best judge of their own reputational risk. At my bank, we safeguard our reputation by conducting due diligence of each customer relationship and monitoring these relationships on an ongoing basis. H.R. 4986 would clarify responsibilities of cooperation between banks and law enforcement in cases of financial fraud. It would promote direct prosecution of fraudsters and preserve access to banking services for legal businesses. In addition, the bill would rein in DOJ's abusive use of subpoena authority and create a safe harbor for banks serving businesses that meet specific criteria. We urge this committee to take up this legislation without delay. The third and last bill I will discuss, the Access to Affordable Mortgages Act, will provide an exemption from independent appraisal requirements for any mortgage with a value of $250,000 or less held in portfolio, regardless of its interest rate or its QM status. When a lender holds a loan in portfolio, it bears the full risk of default and has every incentive to ensure that the loan is appropriately collateralized. In-house appraisals or property valuations performed by bank staff are more cost-effective for the borrower, especially for low-value loans. This draft bill will increase the flow of mortgage credit for moderate-income borrowers and strengthen the housing recovery in rural and small-town markets. Thank you, and I look forward to taking your questions.
Thank you, Mr. Vallandigham. I should have properly introduced you as the President and Chief Executive Officer of First State Bank on behalf of the Independent Community Bankers Association. Thank you for your testimony. Mr. Clendaniel, the President and Chief Executive Officer of Dover Federal Credit Union on behalf of the National Association of Federal Credit Unions. I now recognize you for 5 minutes.
Thank you. Good afternoon, Chairman Capito, Ranking Member Meeks. Excuse me. Good afternoon, Chairman Capito, Ranking Member Meeks, and members of the subcommittee. My name is David Clendaniel, and I am the President and CEO of Dover Federal Credit Union, a position I've held since 1997. I am testifying today on behalf of NAFCU. NAFCU and the entire credit union community appreciate the opportunity to participate in today's hearing regarding legislative proposals to help provide regulatory relief for community financial institutions. Credit unions didn't cause the financial crisis and shouldn't be subject to regulations aimed at those that did. Unfortunately, that has not been the case thus far. At Dover Federal, our compliance costs have more than tripled since 2009, as we don't have the economies of scale that large institutions have. We hear from many credit unions that enough is enough when it comes to a tidal wave of new regulations. Before commenting on the legislation before us today, I would like to update the committee on NCUA's risk-based capital proposal and what impact this rule could have if it becomes final without significant changes. As members of the subcommittee are aware, this ongoing issue is of the utmost importance to credit unions of all sizes. My written testimony outlines in detail the concerns we have with this proposal. Without significant changes to the proposed rule, many credit unions, including mine, would likely consider changing charters away from being a credit union due to the onerous nature of the proposal. A proposal that, instead of emulating the Basel requirements for banks, goes a lot farther, particularly in its risk rates for credit unions. We are pleased that the NCUA has indicated that they expect to make changes in the proposal before finalizing. Still, credit unions hope to have an opportunity to comment and provide feedback on these changes before they are final. NAFCU believes that this rule was so impactful that it needs to be done right with industry feedback throughout the process, so credit unions can be clear on how things work before they start making changes to comply. An important part of this is making sure there's a sufficient implementation period for any final rule. Congress must continue to provide oversight and make sure that the issue is studied and fully vetted for economic impact before the NCUA moves forward. One way Congress could address this issue would be to add language to the Community Bank Mortgage Servicing Asset Capital Requirements Study Act, H.R. 4042, that's before the committee today. Since this bill already tackles an issue with Basel, it could be a suitable vehicle for Congress to weigh in on risk-based capital. I would also like to highlight several other measures under consideration today that NAFCU supports. These include the American Savings Promotion Act, H.R. 3374, that would amend federal law to allow credit unions and other financial institutions to use savings promotion raffle products. As the country recovers from the worst financial crisis of our time, creative programs with clear rules and guidelines that encourage household savings merit serious consideration. The End Operation Choke Point Act, H.R. 4986, credit unions remain concerned with the aggressive nature of the Justice Department's Operation Choke Point program. While preventing fraud is a laudable concern, this program is putting unnecessary onus on credit unions to police activities of legal third parties. The Regulation D Study Act, H.R. 3240. This bipartisan legislation would mandate the GAO to study the impact of the Federal Reserve Board's monetary reserve requirements on depository institutions, consumers, and monetary policy. Federal Reserve Regulation D is a prime example of an outdated regulation that is on NAFCU's Dirty Dozen list. The SAFE Act Confidentiality and Privilege Enhancement Act, H.R. 4626. This common-sense technical fix is welcomed by credit unions. My written statements highlight other measures we also support, including outlining several areas where relief and greater regulatory coordination is needed. I would encourage the subcommittee to consider those areas as well. In conclusion, the growing regulatory burden on credit unions from new laws and regulations is a top challenge facing the industry. NAFCU appreciates the subcommittee's work to review legislation to provide regulatory relief for credit unions. We would urge the committee to move forward on these ideas. Congress should also continue vigorous oversight of the federal financial agencies, including NCUA, and take action on these issues outlined in the statement where appropriate. We thank you for the opportunity to share our thoughts with you today. I would welcome any questions you might have. Thank you.
Thank you, Mr. Clendaniel. The Chair now recognizes Mr. Isaac, Senior Managing Director, Global Head of Financial Institutions at FTI Consulting. Mr. Isaac, you're recognized for 5 minutes for purposes of an opening statement. If you could pull it a little closer and make sure the mic is on.
Now it's on.
There we go.
I had to push a button. Chairman Caputo and Ranking Member Meeks, members of the subcommittee, I'm grateful that you are holding this hearing. The opinions I express today are my own. I do not purport to speak on behalf of my firm, FTI Consulting. And in the interest of full disclosure, some of FTI's clients have an interest in matters before the subcommittee today. By way of background, I was appointed to the FDIC Board of Directors at age 34 by President Carter in 1978 and was named chairman by President Reagan in 1981. I returned to the private sector at the end of 1985 after serving nearly 2 years beyond my 6-year term at the FDIC. I also served during my term at the FDIC as chairman of the Financial Institutions Examination Council and as a member of the Basel Committee. In my view, Operation Choke Point is one of the most dangerous programs I have experienced in my 45 years of service as a bank regulator, bank attorney and consultant, and bank board member. Without legal authority and based on a political agenda, unelected officials at the Department of Justice are coordinating with some bank regulators to deny essential banking services to companies engaged in lawful business activities that some government officials don't like. Bankers are being cowed into compliance by an oppressive regulatory regime. Perfectly lawful businesses are being denied access to essential banking services because they offer products or services unelected officials don't like. This ought to alarm and frighten each of us, irrespective of our ideology, party affiliation, or view of the particular products or services being cut off. Regulators and the DOJ have highlighted some 24 businesses they consider high risk or undesirable. I've spent my entire professional career in banking and bank regulation, and I don't discern any meaningful increase in risk in providing basic banking services, such as deposit accounts, payroll processing, or check clearing services, to any of these businesses compared to a host of other legitimate businesses. Operation Choke Point is fundamentally unfair to the banks and to the legal businesses that find their banking services cut off. Once banking services are cut off to a legal business as a result of a subpoena or the threat of a subpoena, there is no chance for the business to appeal the decision. The company is simply in a business that, while legal, has been determined undesirable and therefore high risk by the federal bureaucracy. This Orwellian result ought to be frightening. It is frightening. If government employees acting without statutory authority can coerce banks into denying services to firms engaged in lawful behavior that the government doesn't like, where does it stop? The point is simple and incredibly important. Under our constitutional republic, unelected government employees should not decide which lawful businesses may have access to banking services and which are to be denied. Those who have serious concerns about payday loans, check cashing services, adult films, family planning clinics, or other products and services should take their concerns to state or federal legislatures and attempt to enact reforms. The DOJ should not be involved in bank regulation to any extent whatsoever. Its job is to prosecute crimes as defined by law. Bank regulators need to stay out of the political arena and focus all of their energy on ensuring that banks are operating in a safe and sound manner and are complying with all laws and regulations. Neither the DOJ nor the bank regulators should be allowed to dictate which lawful businesses will be granted or denied access to banking services. Representative Lukemeyer's bill provides a safe harbor to promote non-discriminatory access to financial products and services by banks and credit unions to businesses that are licensed, registered as money services businesses, or have reasoned legal opinions demonstrating the legality of their business. The legislation also seeks to rein in DOJ's subpoena authority by requiring judicial oversight. Importantly, banks and credit unions would retain their legal authority and discretion in establishing or maintaining relationships with existing and potential customers. The Constitution dictates that the place to debate whether payday lending or any other lawful business should be allowed to operate and have access to the banking system is in the halls of Congress and the state legislatures, not in the back rooms of government bureaucracies. The Lukemeyer bill is an extremely important step in reining in government agencies that are greatly overstepping their authority and breaching the constitutional separation of powers among the three branches of government and between the states and the federal government. While some of us may applaud the attack against payday lending, ammunition distributors, or home-based charities, we will likely take a very different position when a new administration decides to attack activities more near and dear to our hearts. I urge the Congress to enact immediately, without delay, the Lukemeyer bill, as Operation Choke Point is doing severe and irreparable damage to firms engaged in lawful business activities. Thank you.
Thank you, Mr. Isaac. Well said. Thank you for your testimony. The chair now recognizes Ms. Saunders, Managing Attorney from Washington, D.C. National Consumer Law Center. You are recognized for 5 minutes for purposes of an opening statement.
Thank you very much. Chairman Capito, Ranking Member Meeks, and members of the subcommittee, thank you for inviting me to testify today. I am here to speak in opposition to H.R. 4986 and other actions that would weaken efforts to stop banks from facilitating illegal activity. Banks play a critical role in enabling fraudsters to debit consumers' bank accounts. In 2008, the OCC ordered Wachovia Bank to pay $125 million to reimburse elderly consumers whose accounts were debited by scammers. Wachovia had plenty of warning signs of fraud, but chose to continue processing payments for a lucrative client. After Wachovia cut them off, some scammers moved to Zions Bank, where they continued scamming seniors. 3 banks had previously turned down one scammer, but a bank broker that specialized in finding banks willing to take on high-risk clients took them to Zions in exchange for a share of the profits. Minimal vetting would have alerted Zions, which soon had direct evidence of its own, including warnings from regulators and the bank's chief risk officer. But Zions suppressed these concerns in light of the high profits. Zions Bank is one of the banks that have received subpoenas from Operation Choke Point, which focuses on banks that know or willfully ignore evidence that they are facilitating fraud and illegal activity. The first, and to date only, Choke Point case was against Four Oaks Bank and Trust, which helped process payments for illegal and fraudulent payday loans, a Ponzi scheme, and an illegal gambling site. The bank overlooked hundreds of consumer complaints, warnings from state AGs, and extremely high rates of payments rejected as unauthorized. The Four Oaks case is exactly the type of case that the Justice Department should be bringing. But instead of focusing on what DOJ is actually doing, some critics have drawn sweeping conclusions from anecdotes on individual bank account closures. Since long before Operation Choke Point, payday lenders and check cashers have been complaining about bank account closures. In 2006, the Financial Service Centers of America testified that, quote, for the past 6 years, banks have been abandoning us, first in a trickle, then continuously accelerating so that now few banks are willing to service us. That was in 2006. Some of the recent bank account closures may have more to do with the money transmitting side of a payday lender's business than the loan side. Entities with insufficient anti-money laundering regimes may have trouble finding banks. And some banks may prefer not to do the due diligence at all and to leave that line of business to banks that will, as they should. In addition, when banks choose to process payments in areas rife with fraud and illegal activity, regulators are right to insist that they be aware of the risks. Banks that can stop fraud should, And they're also on the hook if they originate a payment that is unauthorized or if the authorization is invalid due to fraud or illegality. If some banks have misunderstood a bank's duties in high-risk areas, that can be clarified. But it would be a terrible mistake to weaken controls that can block illegal activity from the payment system. H.R. 4986 would prohibit regulators from warning banks about the risks of illegal payments. It would create an inappropriate safe harbor for payments processed for an entity with a state license, a money transmitter registration, or even just a letter from its attorney. A state license is no guarantee that a bank will not expose the bank to liability. Cash Call is a licensed lender in many states, but it continued debiting consumer checking accounts for money they did not owe after the payday lender it was collecting for shut down its operations in response to enforcement actions and court orders. Similarly, registration as a money transmitter does not ensure compliance with anti-money laundering or know your customer rules. And virtually anyone can get a letter from an attorney vouching for the legality of their conduct. Remember, fraud hurts more than the direct victims. Online businesses and stores like Target lose business when consumers are afraid to shop. When a scammer's bank debits a consumer account at a small bank, it costs the consumer's bank on average $100 to deal with the unauthorized charge and as high as $500. I urge you to oppose H.R. 4986 and other measures that would undermine efforts to prevent illegal activity that harms millions of Americans, businesses, and American security. Thank you for inviting me for testimony today. I ask that I submit my full testimony for the record, and I would be happy to answer any questions.
Thank you, Ms. Saunders. The Chair now recognizes Mr. Stanley, the Policy Director for Americans for Financial Reform, for 5 minutes for the purposes of an opening statement. Mr. Stanley.
Thank you. Chairman Capito and members of the committee, thank you for the opportunity to testify before you today on behalf of Americans for Financial Reform. AFR opposes H.R. 3913, H.R. 5037, and the Access to Affordable Mortgages Act of 2014. I also note that Lauren Saunders has testified on behalf of AFR as well as the National Consumer Law Center in opposition to H.R. 4986. AFR has no position at this time on the other bills being discussed today. H.R. 3913 would amend the Volcker Rule to, among other things, ban any rulemaking under the section that would, quote, impose a burden on competition that is not necessary or appropriate. AFR has consistently opposed this kind of broad, vague statutory mandates. Such mandates are an open invitation to endless lawsuits by well-funded Wall Street interests seeking to overturn rules that may reduce their profits, even if such rules serve the public interest. This mandate also appears to prioritize competition over other public interest considerations such as equity and financial stability. Existing law already provides ample opportunity for judicial review of agency decisions. Congress should not encourage further lawsuits by placing such vague directives in statute. We also disagree with the premise that the Volcker Rule creates an excessive burden on competition. Bank trading activities are dominated by a small number of too-big-to-fail banks. Restricting proprietary trading at such banks should improve competitive balance, not harm it. Nor should the Volcker Rule harm the international competitiveness of U.S. industry. This claim ignores the 60-year period during which U.S. banks operated under Glass-Steagall restrictions, which were much more far-reaching than the Volcker Rule. This historical experience does not provide evidence of harm to international competitiveness. H.R. 5037 would impose new requirements and duties on the Office of Financial Research. We oppose this legislation as both redundant and harmful. These requirements are redundant because OFR already engages in extensive public reporting, consults frequently with member agencies, and is subject to the full range of cybersecurity requirements applicable to the U.S. Treasury. The requirements are harmful because the specific requirements in the bill would damage the OFR's ability to perform its mission. H.R. 5037 requires the OFR to provide a public advance description of every report, guidance, working paper, or information request to be conducted during the coming year, as well as planned work dates associated with each such action. Besides being unrealistic, this requirement would provide a roadmap to Wall Street interests on how to lobby the OFR concerning each detail of its work in progress. The bill further requires OFR to make public the exact time and nature of every consultation with any member agency staffer regarding any report, as well as every recommendation made in such a consultation. Making these details public would exercise a significant chilling effect on the willingness of member agency personnel to share frank views with the OFR. Even transparency laws such as the Freedom of Information Act provide a deliberative process exemption to safeguard deliberations on work in progress, but this is absent from H.R. 5037. We also disagree that OFR's current level of public transparency or consultation is inadequate. OFR's annual reports and working papers provide significant detail on current and upcoming projects, as well as views on key financial risks. More recently, the OFR has been required to provide detailed quarterly reports to Congress on all spending and actions in the past quarter. The Treasury's recent letter to the House on the OFR's asset management report also shows that the OFR engages in extensive consultation with member agencies. Consultation with the SEC on the asset management report included the exchange of at least 15 draft versions of the report, at least 13 separate meetings, and additional informal consultation. SEC Chair Mary Jo White has stated that the SEC commented extensively on the report when it was in progress. The OFR's mission of studying potential emerging threats to U.S. financial stability is a critical one. In order to perform its mission, the OFR must have independence from political pressures that may affect its member agencies. The way to improve the OFR's work is to support its independence and its ability to act as a warning voice concerning threats others may choose to overlook. The changes in H.R. 5037 would have the opposite effect. The Access to Affordable Mortgages Act of 2014 would exempt higher-risk mortgages of $250,000 or under from new appraisal requirements included in the Dodd-Frank Act. We oppose this exemption. Higher-risk mortgages refers to what were once called subprime mortgages. Fraud and predatory lending connected to subprime mortgage origination was a major cause of the 2008 financial crisis. Exempting higher-risk mortgages of up to $250,000 from appraisal requirements would significantly undermine these new regulatory protections. The $250,000 exemption would include almost half of all new homes sold in the United States and likely well over half of higher-risk mortgage loans. The requirement that a lender retain the loan on their balance sheet for at least 3 years does provide some protection, but data on subprime loan defaults shows significant increases in default past the 36-month point. H.R. 4042 would mandate further study and delay in the implementation of new capital rules on mortgage servicing assets. AFR does not currently have a position on H.R. 4042. However, we do have some concerns regarding this legislation. These concerns are detailed in my written testimony. Thank you very much, and now I'm happy to take questions.
Thank you, Mr. Stanley. With that, we'll begin the question portion of our hearing, and I will yield myself 5 minutes for questioning. Commissioner Klein, you noted in your written testimony and your oral testimony that the NMLS system has been successful in streamlining the licensing system for mortgage loan originators and improving information sharing from state to state. Could you share with the committee why you think H.R. 4626 would bolster these new licensing regimes? But better yet, could you kind of frame it in terms of how it might help protect consumers?
Yes, thank you, Chairman Capito, and thank you for your support of H.R. 4626. Currently, under the SAFE Act, information is protected and shared between regulators, between mortgage regulators. What H.R. 4626 will do is extend those protections of confidential and privileged information between all regulators who choose to use the NMLS to license other types of non-mortgage financial service providers. This system has proved to increase uniformity. It is reducing regulatory burden for the licensees, and it is enhancing better coordination between the agencies, the agencies that license these entities. As far as consumer protections, it does enhance consumer protection, and it benefits not only consumers but the industry as well.
I would imagine, too, that it better protects probably personal and private information for each consumer as their information becomes a part of this system. I mean, that, to me, would be one of the major benefits of this. Is that correct?
That is correct. The NMLS employs numerous controls to protect the privacy and the security of sensitive information. It's required to be compliant with the Federal Information Security Management Act, which it employs over 154 controls that are reviewed, validated, and tested by an independent third party on an annual basis. The NMLS is also required to comply with all state and federal laws. But yes, in fact, it is a secure system.
Thank you. Mr. Vlandingham, one of the issues we're discussing today is the ability of financial institutions to maintain mortgage servicing rights for the mortgages they originate. As you noted in your testimony, recent regulatory actions are making it more difficult to do so. Can you share with the subcommittee how your institution views mortgage servicing rights and what that means for you as a community bank to still be engaged in this practice and how that would influence consumers in your area?
Absolutely. As I stated in my testimony, we would lose $1.6 million in Tier 1 capital. I have spent half my life building our servicing portfolio, and it would take that business model away from us. Our primary business line is mortgage lending and the servicing that subsequently is created by that. And ultimately, we would have to dramatically change our business model because we could no longer grow and build that servicing. You know, it's in a time period when servicing has increased cost, and ultimately our economies of scale have been crushed. And at that point in time, this would hinder us from continuing to grow and being able to build on a business model that's been extremely successful for our organization. In terms of our consumers, I daily get requests of borrowers who want to either buy a new home and come back to us because of the service that they get. Community banks are better positioned to provide the high-touch, high-quality service to mortgage borrowers than some of these non-bank shadow market servicers that have grown exponentially because of this. So ultimately, I think community banks do a better job of it, and we want to continue to build on that. This will absolutely cap that business and take small banks out of the servicing market.
And I would imagine, too, as your customers would prefer to know exactly when and how and who is servicing their mortgage rather than have it be often a different state or, very remote from them. Sometimes people run into problems, and being able to go to the institution where they know is carrying these servicing rights would be, I think, a bonus to consumer, correct? My
employees have such close relationships with their borrowers that they often get letters. They know about their family events. They even get presents at holidays. When you call our organization, you want to ask about your mortgage, you know that Debbie Kearns is going to answer the phone in escrow, and she's going to explain your escrow analysis to you.
Right.
If you were to call one of the larger national non-bank providers, you don't know who you would get. You might even get a recording, and you don't know that you would get your question answered.
Thank you. I'm going to run over my time. Thank you. Mr. Green?
Thank you, Madam Chair. Thank the witnesses for appearing, and I'm also very grateful that I live in a country where no one is above the law, and I'm especially grateful to God that I live in a country where no one is beneath the law. If there is one among you who believes that banks do not break the law, would you kindly extend a hand into the air? I take it from the absence of hands in the air that there are none among you, and I ask that the record reflect that no one believes on this panel that banks do not break the law. Mr. Blanton and Mr. Isaac, there was a case that has been mentioned out of North Carolina, a case that involved hundreds of consumer complaints, as was indicated by Ms. Saunders, a case that involved many, many complaints from banks, a case wherein a settlement was made for $1.2 million. This bank received $850,000 in fees. The Justice Department interceded, and as a result, there was some redress. I hope it won't surprise you to know that earlier today there was a witness present from the Justice Department who indicated that but for this Operation Choke Point, that settlement would not have taken place. So I ask you, my dear friends, Mr. Isaac, do you have any disagreement with the settlement against Four Oaks Bank? Mr. Isaac?
I'm not intimately familiar with the case, but
All right.
I understand that there was some fairly egregious behavior there, and I believe that that there should have been action taken. And
Thank you very much.
And I don't believe that Operation
Let me, if I may, go to my next witness, and I'll come back to you.
Could I just finish?
Not just yet, if I may, please.
Okay.
I want to accord you every courtesy. I don't mean to be rude, crude, and unrefined, but I have a limited amount of time. Let me now move to Mr. Blanton. Do you find any reason to differ with the way that case was resolved, and do you find that it was appropriate to take action given that banks were complaining against Four Oaks?
Well, from what I understand, I believe that there were instances that happened. I think there were plenty of signs there to indicate that, and I think action happened. Whether or not choke point was a trigger to it.
If I may, let me intercede again because I've got a minute and 40 plus seconds. A witness from the Justice Department, I can accord you his name for edification purposes, Mr. Deliri, Assistant Attorney General, Department of Justice, indicated that it was Operation Choke Point that gave them the opportunity to bring to justice this circumstance. I have read the bill that you both favor, and I respect my colleagues. But are you desiring to put banks in a position such that they cannot answer for unlawful conduct, Mr. Isaac? Is that your desire?
Of course not. I prosecuted.
Is that your desire?
I prosecuted a lot of.
Mr. Blanton, is that your desire? Is that your desire?
No, sir, it's not.
Well, this bill produces more than a safe harbor. It provides an escape from liability.
I would say, though, if the bank was doing its job properly.
Well, the bank wasn't doing its job properly, and that's why you and I are having this discussion. It wasn't doing its job properly. Do you want banks to just have an absolute get-out-of-jail-free card so that they can take advantage of consumers? You heard Ms. Saunders talk about the hundreds of consumer complaints. Ms. Saunders, is that correct? Were you correct when you said that?
I was quoting from the complaint in the Four Oaks case, yes.
Could you pull your microphone a little bit closer?
Sure. Yes, I was taking those facts from the complaint in the Four Oaks case.
And do you concur that it was necessary for the Justice Department to intercede?
Absolutely. They stopped a lot of fraud and illegal activity by intervening.
Thank you, Madam Chair. I yield back.
Thank you. Mr. Duffy for 5 minutes.
I was going to ask a poll question about how many of you think that federal bureaucrats and Obama administration officials are breaking the law, but I'm going to skip that right now. Ms. Saunders, I want to talk to you about Operation Choke Point. You agree with this policy from DOJ, is that correct?
Yes, as I understand it, the operation focuses on fraud and illegal activity in banks that are in a position to stop it, and I agree with that focus.
And you went to law school, you're an attorney, right?
Yes.
And were you here for the testimony this morning?
I was not.
Okay, so we heard from Mr. Deliri from DOJ, and during the course of his testimony, he was constantly talking about fraudulent merchants. Fraudulent merchants had to be addressed through Operation Choke Point. The problem is that Operation Choke Point focuses on these merchants' ability to bank, but doesn't look at any fraudulent behavior with the merchant themselves. And so if you don't bank a third-party payer or a payday loan institution or a gun sales institution, they can't do business. You put them out of business. But there's no due process. There's no ability to have a hearing. There's no ability to have a judge hear testimony and make a determination of, yes, these people have committed fraud, or no, they're innocent. What you have is a bureaucrat in the DOJ saying, like you just said, I've done an investigation, I've taken complaints, and this is fraud. You believe in due process, don't you?
I do.
And if you're one of these subject merchants, don't you think that they should have due process? Shouldn't they have a hearing to determine whether they have committed fraud under our laws or whether they're innocent? We shouldn't have just bureaucrats in the DOJ do this, should we?
I think if a bank has a merchant that has unauthorized returns that are through the roof, warnings from regulators of fraud and illegal activity, I don't think we need to wait for a trial to track down the people around the globe who may be scamming people before the bank says, you know what, I think there's fraud going on here and I'm not going to be a part of it.
And you know, when I was a prosecutor, and we'd collect a lot of evidence and a lot of firsthand statements and complaints, and if we just convicted people without a trial and said, well, if look at all the information, I'm not going to track down this defendant and give them due process. I'm not going to give them a trial. I mean, what kind of government do we become if we don't offer these protections to what we would all believe is a legitimate business until proven otherwise? When you have just bureaucrats say, I've done an investigation, it's not open, it can't be reviewed by the Congress, it can't be accessed by the merchant, and I've just found that you have committed fraud, and we're going to cut off your ability to bank. Is that the right way we should do business in the American government? Because that's what they're doing.
I think it's a surprising statement to say that a bank should not stop processing payments when they have substantial, egregious evidence of fraud going on, and that they need to keep processing payments and debiting consumer accounts.
I don't know what law school you went to, but we afford people due process. We just don't say there's evidence, and so I convict. Is that what I mean? That's what I mean. I'm astounded that you are giving this testimony today, saying there is evidence, no trial, just conviction with evidence. I mean,
well, I see no conviction here, but in the Wachovia case, for example, I don't think it would be right to continue letting scammers debit seniors' accounts just because we haven't yet had a trial of all those scammers. If Wachovia knows what's going on, they know these are scammers using them to debit consumer accounts, they ought to stop it.
Sure, but then shouldn't we? This is not the only case, and there was only one example that was given of someone who was prosecuted on the merchant side, and Wachovia was cited. But beyond that, no one else has been prosecuted. And I guess I would ask the panel: do you know of merchants that have been put out of business because you've been unable to bank them because of Operation Choke Point, Mr. Blandingham?
Yes, there was a current news article that Chase had been closing accounts for pawn shops in the state of West Virginia. So they've been given 30 days to move their account, close the account. They've done nothing wrong. They're not debiting anyone's account. Just as a business class in our state, they are eliminated from the banking system.
And do you have any knowledge that they had a trial and a determination that they were doing business fraudulently?
Absolutely not.
Right. So they didn't have due process, correct?
No, they did not.
And Ms. Saunders, that's my concern. We need to have due process in this country, and we don't want bureaucrats in Washington sitting in the DOJ convicting people without a hearing. And I guess that's why I come to Mr. Luchtemeyer's bill. Does the panel agree that Mr. Luchtemeyer's bill takes a step in the right direction to make sure we give some protections to merchants from bureaucrats in the DOJ scheming to go after businesses or merchants that they don't like? Yes.
Yes, we support the bill.
Well, my time has expired. I yield back.
Thank you. Mr. Perlmutter for 5 minutes.
Thanks, Madam Chair, and I agreed to give Mr. Green an opportunity to respond to Mr. Duffy for just 15 seconds.
Thank you very much, and I take all of these
Yield to
things.
Mr. Green.
I tend to take things seriously, and thank you very much. If others perform activities that are unacceptable, I don't believe it gives us a license to accord unacceptable activities to other entities. And I just want to go on record as saying, whatever happens anywhere else doesn't change our need to make sure that we help protect consumers. They should not be beneath the law, and no one else and no other entity should be above the law.
Okay, reclaiming my time. Thank you, Madam Chair. Mr. Isaacs, good to see you.
Good to see you.
I'll start with the choke point question that we've been dealing with, and I'm somewhere between Mr. Green and Mr. Duffy on this. That Clearly, there were some bad actors. Those bad actors, through an investigation, have been ferreted out. But in my opinion, you don't create then a dragnet that then continues to sweep more and more people into it. On a case-by-case basis, you look for the fraud and you punish the fraudulent. So I agree with Mr. Green to a certain degree. Mr. Luchtemeyer's bill, I think, is generally on the right track, but goes too far, especially on the liability component of it. But I do appreciate his safe harbor piece, especially as it applies to something going on in Colorado and 23 other states. And that is, in fact, that those states have provided a regulatory scheme for the use and business of marijuana. And part of what's going on is it's very difficult for those businesses to bank. And I would introduce, Madam Chair, or wherever you are, the USA Today article from yesterday concerning the security measures that so many have to go
Without
to.
objection.
So that I would like to see that those particular businesses that are legal in their states can continue to do business in a way that they aren't shut off from the banking system. And I do think that Mr. Luchtemeyer's bill does provide for that. So that's a saving grace of the bill for me. My questions, though, I'd like to, Mr. Stanley, you were talking a little bit about the mortgage servicing. You said you really didn't have any complaints about it. You still had some questions. What are your questions about it? Because I'm supportive of kind of delaying it, making sure that the mortgage servicing doesn't flow from community banks and insured institutions to non-banks. You know, there are plenty of non-banks. I'm happy for them to have business, but I don't want the insured institutions losing that business either. What do you say about that?
Well, I think two things. In terms of our questions, the prudential regulators did carefully consider thousands of comments on their proposed Basel rules, and they chose to significantly ease capital requirements in many areas, including residential mortgages, but they did not modify the ceiling on these mortgage servicing assets. And I think what we would like to see is more of the information from the regulators on how and why they reached that decision that might have included a lot of the data that this study might produce. And in terms of movement to non-bank servicers, we feel there's a lot of things driving that it isn't just these capital rules, it's reputational, some of the violations, frankly, that the big banks did on servicing, some of the settlement issues. So there are a lot of things driving that, we feel.
Okay. Well, thank you. I think that there are a lot of the Basel components, though, in my opinion, play a big role in driving some of that mortgage servicing to the non-banks. And that's why we're asking for a little bit of a timeout to just make sure whether I'm right or wrong. And so that's why we're doing it. Madam Chair, if I could, I'd like to introduce into the record a letter of September 13, 2013 from the Board of Governors to me concerning mortgage servicing assets, and then also a letter, oh man, I got lots of letters, January 27, 2014 from the Board of Governors of the Federal Reserve concerning that, and then also Independent Community Bankers May 20th, and from the American Bankers Association May 12th.
Without objection.
Thank you. I yield back.
Mr. Westmoreland.
Thank you, Madam Chair. Mr. Stanley, when was Americans for Financial Reform? When did you start?
Americans for Financial Reform was created, I believe, I wasn't there at the time, in 2008 as a response to the financial crisis and the feeling that people needed to speak.
That's okay. That's all I wanted, the 2008. Thank you. Now, to the 6 witnesses that live in the real world and have real-life experiences of lending money and banking people and working in the business, with respect to the FDIC's complicity in Operation Choke Point, are you familiar with a list of high-risk activities identified by the FDIC in the summer of 2011 Supervisory Insights entitled Managing Risk in Third-Party Payment Processor Relationships. Are you aware of any other list of high-risk merchants or activities published by the DOJ, FDIC, FRB, or OCC? Just a quick head shake, good. Were any of your institutions offered the opportunity to comment on the list before it was compiled and published? Nobody? Have any of these agencies reached out to your institutions since the list was published to determine the impact on your industry? Well, that's a little weird, isn't it, since it involves your industries. You would think that the government would at least want to have some input as to this. Mr. Isaac, I know that you were past president of the FDIC. Did you ever see anything while you were there that the administration would have wanted to coordinate with regulators to specifically cut off access to financial services?
No, other than as prescribed by the law, for example, money laundering and so forth. But apart from that, cutting off drug dealers, terrorists, and so forth, which was enacted by Congress, no.
Mr. Isaac, I want to ask you one other question. You briefly mentioned the idea that examiners and bank regulators are more concerned with the bank's reputational risks, seemingly to the exclusion of all other concerns, save the capital ratio. Is it possible this emphasis on reputational risk is detracting examiners from seeing other problems that may be happening in a bank?
Well, I do believe, and I said in my in my full testimony, that I'm very concerned about the degree to which the examiners over the past couple decades have started focusing on reputational risk, which I don't know what it means. I don't know anybody who knows what it means, except that the bank's doing something that the regulator doesn't like, but the regulator can't seem to quantify the risk and put it into the CAMELS rating system, which is the objective standard we're supposed to be using. So I'm very concerned about where we've gone with reputational risk. I would get rid of it. I don't think it's a helpful concept at all.
Thank you. Mr. Blanton, while I support, the bills that are being considered today, I don't think any of them come really close to being the substantive regulatory relief that I've hoped that this committee would one day take up. There's still some issues around accounting methods, regulatory capital, classification of distressed assets, examiner overreach, and overreaction that I still hear from bankers every day. Are these the things that, as Vice President of the American Bankers Association, are these the things you're hearing every day too?
Yes, they are. I mean, we have a tremendous burden on our banks that, especially is disproportionate to the smaller banks, and that they just really don't have the resources available. And it's in a one-size-fits-all mentality to where the same regulations at my bank at $1.8 billion has to comply with and a $200 million bank has to comply at the same level. It's very difficult for them to do that.
Thank you. Madam Chair, I yield back the remainder of my time.
Gentleman yields back. Mr. Heck, 5 minutes.
Thank you, Madam Chair. I would like firstly to associate myself with the remarks from the gentleman from Colorado, Mr. Perlmutter, with respect to Congressman Luetkemeier's legislation, both with respect to the desire to seek a happy balance within it and its positive intent, and also with respect to his concerns regarding the impact on states which have legalized some form of marijuana consumption. And I would also like to thank the chair. There are a lot of bills on today's agenda that we can vote out of this committee in a bipartisan way. And if I might editorialize, we don't have enough days like that, and I thank you for it. Let's see, who am I going to pick on? Is it Mr. Fetcher? I'm sorry, I don't know how to.
Yes.
Yeah.
Fecker.
Fecker.
Yep.
hard K.
Good old German family.
Yeah. I think I know that as a heck. I'm enthusiastic about H.R. 3374, the American Savings Protection Act. And I note that there are federal laws which have the effect of prohibiting banks and certain thrifts from offering certain kinds of these, if you will, safe, regulated, and innovative savings products. And I'm just wondering, from your professional experience, sir, can you think of any compelling policy basis for enabling certain financial institutions to offer these but prohibiting others from doing so?
No, I cannot.
As you read the legislation, Mr. Fecker, is there anything in it that would preempt existing state laws in any way? Does it change a state's ability to regulate these kinds of products whatsoever?
Not to my knowledge, no.
Would these products be subject to the same kind of regulatory oversight as any other financial product offered by a bank or credit union?
I believe they would, yes.
If you were to offer this in your institution, I assume you do not at the present time, would you pay for the promotion out of your marketing account and use that as an attraction for a cash prize to
yes, we would.
incentivize increased savings?
Yes, we would.
You're an awfully easy witness to work with, Mr. Fecker. I'd like to...
We've had a lot of experience about these prize-based accounts. They help average Americans decide to save money because the interest rates that we're able to pay on our deposit accounts are so small. If you're saving $500 or maybe $1,000, it's not really much of an incentive to get a 0.25% interest rate on that. And so the perceived value of the opportunity to win something more meaningful will cause many Americans to establish a savings program that they might not otherwise have done. And we've seen that in the institutions that have done this. And so as a matter of public policy, that's why I support it. I think we want Americans to save more money, especially Americans of more modest means that don't have the significant sums of money where interest rates matter more than this perceived value of these prize-based accounts. So I think properly done, it's a matter of good public policy.
It took me 4 questions to get you to give the speech I wanted you to give, but I am extremely grateful, sir.
I caught on after a couple of seconds.
Well, I think the point is made. We don't save enough, and anything that we can do that does not compromise the consumer, that incentivizes the kind of behavior that every single person sitting in this room believes would benefit them not only as individuals but society as a whole, ought to be an easy public policy to pursue. And I want to publicly acknowledge and thank both Mr. Kilmer and Mr. Cotton for offering this legislation, in hopes that my colleagues will give it a yes vote as soon as they can. I guess I've got a minute left, so I'll get to the meatier stuff in some regards, I guess, or the more controversial stuff. You've raised some questions about the NCUA's risk-based capital rule, that's proposed rule. I've shared those concerns. I've expressed my concern to the NCUA. I'm not sure about the whole shift to risk weightings after we saw what we did in the financial crisis. But if we are to go ahead and do something in this regard, I'd be curious and interested to know your reaction of what your reaction would be to that which I would only think is fair, to combine it with giving credit unions tools to raise additional capital. And as you know, there's legislation before this committee to do that.
Right. Well, thank you, Representative. That's an important question. The NCUA's rule, as well intended as it may be to ensure that credit unions are adequately capitalized for the risk on their balance sheet, the rule as written, as proposed, actually requires higher capital risk weightings in many categories than even the community banks, despite the performance of credit unions through the recent Great Recession. And so that's the start of our concern. You add that to the fact that a credit union's only way of raising capital is through its earnings. What it ends up meaning is that credit unions will be able to deliver less value to their members on the street. And so what we ask is that the subcommittee exercise oversight over NCUA's rule. Now, we believe NCUA will change the rule
based on the over 2,200 comments that they received, but we believe it needs to be changed substantially. Frankly, our hope is it's withdrawn and they start over again. Short of that actually happening, we would hope that the committee would take a good look, ask questions, kind of to what Mr. Stanley said before. How do you justify these risk weightings? What's the empirical evidence behind them? Because if we set risk weightings that are just simply too high, it will cause credit unions to withhold value from their consumer members on the street, and I don't think anybody wants that to happen.
Thank you.
With one additional second of indulgence, I just want to reiterate, we really are very grateful to have before us legislation that we can all support. Thank you, Madam Chair.
Thank you, and I think we'll give credit to where it's due for the ranking member as well. We've worked together on these. I would also like to ask unanimous consent to insert the following member opening statements. Mrs. Capito, Mr. Duffy, Mr. Lukemeyer, Mr. Westmoreland, Mr. Cotton, Mr. Pettinger, Mr. Stutzman, and Mr. Meeks. And with that, I will yield 5 minutes to the gentleman, to Mr. Lukemeyer for questions.
Thank you, Madam Chair. I'd like to ask the first question with regards to the appraisal requirement bill that we've got before us. And Mr. Blanton, I want to ask it of you. This section removes the appraisal requirement on primary residence for those loans under $250,000 and held in portfolio by a creditor for less than 3 years. Can you tell me, if we do this, what's the kind of risk that the bank's exposed to by going along with something like this?
Well, by and large, we're exposed to the risk of making the loan and having this asset. And we can do evaluations that are more cost-conscious ways of determining the value of our asset.
So in other words, there's not going to be a whole lot more risk. Basically, number one, the amount of the loan is kind of minimal compared to the size of the portfolio, probably, I would imagine. And number two, you know the customers, it's something's held in your portfolio, therefore you're not somebody that's going to be concerned about this as if it's somebody that's a fly-by-night guy.
No, I mean, with this asset in our portfolio, we understand the customer, we understand the risk we're taking, and we have various tools that are price competitive for this customer to be able to handle this loan for him at a more reasonable price.
Perfect. Thank you very much. Mr. Isaac, loved your testimony. Thank you very much for your comments on choke point. I love that, the most dangerous program that you've ever seen. I'm going to keep that quote. But I appreciate your being here today, especially from the standpoint that you're somebody who's not just talk the talk, you walk the walk. You've been there, you've done that. I was an examiner a long time ago whenever you were actually FDIC chairman. So that's how long it's been. But I appreciate your remarks today. And just kind of curious, I know you were supportive of the bill. Can you tell me, I know there was a couple of remarks with regards to going too far. Does the bill address, in your mind, the problem that we have in the correct way with DOJ and the FDIC joining together to try and root out entire industries of businesses versus going after the bad actors? Do you think that this bill goes far enough or too far or just right? Can you give me an analysis, please?
I think it's just about right, and I'm not saying that people couldn't find ways to improve it here or there. I mean, we can always try to do better on anything, but I think it's just about right. I've heard Mr. Deliri's name mentioned several times in this hearing, and I guess he testified this morning. He has a memo. It's a September 9, 2013, that I would hope that everybody would read, particularly pages 10, 11, and 14, in which he makes some outrageous and very scary statements. For example, this is on page 14. We are targeting banks. We are targeting banks more than payment processors, and payment processors more than merchants.
Well, one of the things
the theory is that if you target the banks will run these people out of business, and you don't have to spend money and resources going after the merchants. And he actually says that.
One of the things let me interrupt just a second. Sure, one of the things that concerns me is the fact they're doing this under FIREA. And I'm sure you've adjudicated this law many times.
Yes.
And you know that this is supposed to be a bill that is used to provide a defense for the banks rather than for a bill that goes after the banks, which is what they're trying to do. Is that a correct characterization of of the law?
The
And what's going on?
The provisions they are using were intended to protect the bank against fraud from
And they've flipped the
outside
model,
others.
haven't they?
And they're being used to punish the banks.
Their own inside memos indicate that they're not sure they even have the legal authority to do what they're doing. I mean, the other Oversight and Reform Committee has got that.
He says in his own memo that this is dubious.
Yeah.
I think it's less than dubious.
Can you give me a brief overview of what you think will happen? Let's say we pass this legislation, the 4986. What will happen? How will be the response of the banks to this legislation?
I'm sorry. What
will be the response by the banks to this legislation? Or are they going to? How will they react to this?
Unfortunately, it's not going to be an overnight panacea.
Right.
That when the banks have already thrown people out that are legitimate businesses, it's going to take time to get them back into the banking system. But once the safe harbor is there, the banks are going to be able to make business decisions again. But I think they're going to be very leery, having had the regulators say what they've said about undesirable businesses and risky businesses. I think they're going to be very slow to come back in. But hopefully we can turn this around over time, and we can stop the exodus. We can stop legal businesses from being thrown out of the banking system.
And if they do that, they're not going to go back in with somebody who's a bad actor.
Pardon?
I say they're not going to go back into business with somebody who's a bad actor. They're going to pick and choose from all these folks that they've let go. They'll go back out and pick all the good ones, wouldn't they?
Yeah, gentlemen's
One would
time's
think.
expired. We're going to
Okay.
move on.
Thank you,
because
Madam Chair.
We're heading up to votes. Mr. Meeks.
Thank you, Madam Chair. And I want to join what Mr. Heck has said. Balance is, I think, the key to this, to everything, is that having the proper balance. And there's no question, I think, that most members, especially on this committee, recognize that the regulatory burden on smaller and community financial institutions is significant, and we need to provide regulatory relief. The key is the balance, and it's got to be the right relief to the appropriate sector, because entities, there's still risks. There's still risk. Risk still exists in the financial system. The larger banks are still getting bigger, and they're still too big to fail, and the expectation of rising interest rates poses a significant risk to the community financial institutions. So we do have to move quickly, but we also have to be careful, I think, to make sure that it's the relief that is the right relief, it's the targeted relief, and that's what we're trying to do here. And so that's why I agree with Mr. Heck that many of the bills that's up today for discussions are targeted proposals that have gathered support, Democrats and Republicans, bipartisan. And so I congratulate my colleagues on both sides of the aisles, for we're all in this together. I want to particularly say, that I'm supporting and think that great 3240 by Mr. Pittenger, 3374 by Mr. Kilmer, 4626 by the chair, and 5062 by my friend Mr. Palmetto. All bills, I think, bipartisan. We're working on together, trying to get it right. Sometimes when it takes time to do that. Now, I have had and do have reservations on my friend Mr. Lukemeyer's bill, 4986. Although I do have great and strong concerns about the choke point and how legal businesses have been impacted by this initiative. But the question is, does it go a little too far? Because I oppose any attempts to weaken the appraisal standards as I think proposed. I'd like to talk to you about that at some point. And let me just start there, and maybe I'll ask Mr. Stanley, and my question then tells you why. Has there been any evidence that the existing appraisal regulations have led to restrictions in access to credit for low and moderate income borrowers? Because that's where my concerns align. Mr. Stanley.
I'm not familiar with any such evidence, and there is substantial evidence that I think appraisal fraud did harm low and moderate income buyers prior to the financial crisis.
Thank you. And let me let me just say, But I'm just looking at the time. I want to ask Ms. Sanders a question also. I've stated that I have concerns about the way operations choke point has impacted some of the legal entities that have operated within the law. Tell me, do you think that the approach that 4986 is the right approach to deal with this particular problem?
No, I don't. I think it would weaken tools against fraud. I think it would give a blank check to entities who happen to have a license but may still be engaged in illegal activity that banks can stop. I think, the reasons that banks choose to close particular accounts are complex, and we can't just look at the headlines. There's 17 million Americans in this country who don't have bank accounts, many who have been blacklisted from banks. I'm sure we could find some patterns of businesses that they're involved in. And banks make their own business decisions about what areas of business they want to be in. Things like money transmitting. Unfortunately, all the fraudsters out there, it forces us to be vigilant. If we want to stop money going to drug cartels and other illegal activity, we need to be vigilant. Some banks don't want to be in those lines of businesses. There are areas like debt settlement, the debt relief firms. We've done a lot of work against foreclosure rescue fraud, student loan debt relief scams. Anybody who watches TV sees those. And there's a lot of illegal and fraudulent activity out there. So banks need to be vigilant. But I don't see any widespread evidence of a problem. If there's any miscommunications, I think those can be rectified without legislation.
See, and we do have to be vigilant. But unfortunately, what happens is we make laws, and we make laws for the bad guys, not for the good. Most of the folks that are sitting at this table all do good and have good business practices. Sometimes, and that's why I say we got to have the balance, because we got to try to make sure that when we do this balance, we don't, make laws that then overly negatively impact the good guys. But at the same time, we can't hurt the consumer and the individuals, and that's why I just like to talk to Mr. Lukemire and some other, because I just think we go a little too far. Thank you, Madam Chair. I know we've got votes.
Mr. Pittenger.
Thank you, Madam Chair. Thank you for calling this really important hearing, which has really clarified so much of how the regulatory environment has impeded the availability of credit and capital to consumers. I served on a community bank board for 10 years and certainly appreciate the impact of what's happened to community banks and to credit unions. What has happened, of course, is we've diluted the availability of those institutions and reduced them another 1,500 banks that aren't there today, aren't there to serve their communities. So that's a great concern to me. I would like to express thanks to Congresswoman Maloney for co-sponsoring with me H.R. 3240, the Regulation D Study Act. Mr. Fecker, you spoke in some degree regarding that study bill. I'd like you to just elaborate some of why you think this legislation is necessary.
Well, the legislation is necessary because Regulation D, which I would imagine a lot of folks in this room have never ever heard of, causes unnecessary NSF charge to consumers when they exceed the statutory maximum number of automatic transfers from a savings account to a checking account to cover drafts or debits that may come in. And it is not an uncommon occurrence, especially with the way money moves through the financial system today, that a member of the credit union, which happened at Right Pac Credit Union just last week, calls up and says, "Why did you charge us NSF fee?" We attempt to explain to them that they exceeded their number of statutorily required automatic transactions of 6 in the month, and they say, "What?" And they first think it's the credit union's fault, and then we explain, no, this is a federal regulation that we have to enforce, and frankly, that makes them madder. So we advocate for the bill, and we think it should be studied. We hope that the outcome of the study is that this tool for monetary policy, that number of transactions could almost be tripled without impacting the use of that regulation in terms of monetary policy. So really briefly, that's what that regulation is all about, and we support the study.
Let's put it in context in terms of where we are today with technology and when this bill went into effect, this regulation went into effect, the rule of 6 transfers, there's been quite a change. It's just a logic to review this today, it seems to me, from where we were before. Mr. Blanton, you're nodding your head. Would you like to make a comment?
I do also agree. I mean, you're in fact penalizing people for properly managing their money. And with this system that it is now, it's archaic for when it was originally put in place. And it's very difficult for us to compete with non-financial institutions that also compete for deposit dollars that don't have these restrictions.
Sure, Mr. Clendaniel?
I definitely agree with those comments. This is a common sense bill for an outdated bill.
How can consumers who are affected by the limitations or on withdrawals put on the savings accounts? How are they really affected by this?
Well, again, to echo what Mr. Fecker said, there's a lot of confusion, first off, on their behalf. And they just don't understand the fact that what does that mean? You know, what does it mean I can only do 6 this month? I did 6 last month at the total line, yet I can only do 6 online this month. So there's a confusion between where and how they can do those different transactions. Because in their mind, a transfer is a transfer, no matter if they do it by check, by teller, or by online services.
Good. Mr. Isaac, you're nodding. Have you got a comment?
I agree.
All good. All right. Thank you very much. I yield back my time.
Gentleman yields back. It's the desire of the chair to finish the hearing before we've been called for a vote. We have about 7 minutes. We have 2 questioners left. Mr. Barr.
Thank you, Madam Chairman. For Ms. Klein, as you know, Dodd-Frank placed finance companies, non-depository institutions under the jurisdiction of the CFPB, but because of an oversight, the Act did not extend traditional protections of privilege to a variety of information that would be ordinarily disclosed in the course of a supervisory exam, either to CFPB or to state agencies. Mr. Perlmutter and I have introduced a bipartisan bill called the Examination and Supervisory Privilege Parity Act of 2014 to remedy this situation and to provide regulators and regulated parties with greater certainty about the protections that apply when information is shared to and among regulators. Why is this legislation needed, and what kind of disclosures would this foster in your mind that are not currently?
State bank regulators and CSBS are in support of this legislation. We think it's important that privileged information be covered, but in addition to privilege, we would recommend that the language be expanded to include confidentiality. In my home state of West Virginia, information shared with my banking agency is shared under confidentiality rules. It doesn't cover privilege, so that would be our only recommendation, that your legislation also include a protection for confidential information as well.
Thank you, Ms. Klein. And for Mr. Blanton, Mr. Vallandigham, and Mr. Isaac, earlier today at another hearing, I shared with the Department of Justice and financial regulators the following story from a Kentucky resident who had received communication from their bank, and the email to our office was as follows. Our family company, and this is in reference to Operation Choke Point, our family company has been in the business of leasing our land to coal producers for decades. Today I returned a call from client services at our bank in Lexington, Kentucky. They asked if we lease land to coal producers that operate surface mines. They said that we are receiving pressure from bank regulators and will no longer do business with us if we have surface mines on our property. Now, to a man, every one of the regulators and the Department of Justice denied that they're participating in the EPA's war on coal. They denied that, notwithstanding what we know about Operation Choke Point. But my question to you all is, as bankers, does it surprise you that a family business that does business in a politically targeted business, namely surface mining, would receive that kind of a communication from their bank in light of the regulatory pressures that we are seeing? Mr. Blanton?
It doesn't surprise me at all, unfortunately. We're seeing this in a lot of cases, and that wasn't on the list, the FDIC list, that wasn't there. But we're seeing this in a lot of cases to where undue pressure and judgments and opinions of whether it's a good or bad business are now being pushed down to the bank and forcing us to try and take action against customers such as that.
Well, that is the slippery slope that scares us all. I mean, today it's these 24 businesses. What is it tomorrow? And at the end of the day, we're going to have to make choices about legal businesses, whether we can bank them or not, and ultimately put ourselves at additional liability. Take another step further. It's a superstition of states' rights. I mean, in our state, payday lenders aren't legal, so we don't have that issue. But in the state next to us, they are legal. So, ultimately, we're going to have to make some real-world decisions that I don't think we should be forced to. And if somebody's committing fraud, we support the prosecution. But the bank wasn't committing the fraud. The third party was.
Mr. Isaac?
It doesn't surprise me at all, and it scares me. I don't know where we're going.
Well, I think to your point, Mr. Isaac, that a bank's board and the bank's management is in a much better position to ascertain the reputational risk of that bank than an unaccountable, unelected federal regulator in Washington, D.C. And what the irony of all of this is that under Operation Choke Point, the Department of Justice is disfavoring certain politically unpopular businesses by denying them banking services, but at the same time, they issue guidance designed to help illegal businesses like marijuana dealers get access to banking services. So what this tells me is that using prosecutorial discretion, the Department of Justice is picking winners and losers in the marketplace.
Thank you. We're running close on time here.
Thank you.
Mr. Royce.
Appreciate the indulgence. I yield back.
Well, thank you, Madam Chair. I appreciate you holding this hearing. I introduced one of the bills before us here today, alongside the gentleman from Florida, Mr. Murphy, to bring some common sense reforms to the Office of Financial Research over at the Treasury Department. That bill is H.R. 5037, the OFR Accountability Act. It does ensure improved transparency and better interagency coordination and stronger cybersecurity protections at the OFR. And I think members of Congress on both sides of the aisle have heard constant criticism about the quality of research at OFR, the lack of real coordination between the office and federal financial regulators, and much of the criticism, frankly, is focused on the Asset Management and Financial Stability Study published in September 2013 that they did. With respect to this report, the House Oversight Committee found that the OFR failed to meaningfully consider the expert analysis provided by the career professional staff at the SEC, resulting in what a group of former regulators has called a flawed analysis of asset managers and fundamental misconceptions about how security markets function. The Oversight Committee concluded that while OFR paid lip service to the SEC's staff suggestions, OFR failed to meaningfully address the important issues flagged in the SEC memorandum. So I think this legislation does it in a thoughtful way. The bill Mr. Murphy and I put forward is balanced. It's a bipartisan approach that includes reforms to the OFR that, frankly, its inaction absolutely necessitates. So I look forward to moving that bill expeditiously. I do have one question quickly. Maybe Mr. Clendaniel could speak up on this, but it's on another subject. Madam Chair, if I could ask our credit union witness what specific next steps they would like to see this committee take as it relates to NCUA's risk-based capital proposal.
I don't think I have enough time to go through all the steps with the time allowed, but I think the one thing that could be done to help all credit unions and all 100 million members in the country is to include the NCUA proposal into H.R. 4042 and do a stop and study to make sure we know the full impact of what their proposal is and what's also the right proposal for credit unions and for the members.
Well, Madam Chair, because we have a vote on, perhaps I could put my full opening statement in the record, and Mr. Clendaniel could put a full proposal forward, and with that, I'd yield back, Madam Chair.
The gentleman, understanding the time constraints here, I would like to submit for the record these statements from these organizations: the Appraisal Institute, Consumer Financial Services Association of America, National Association of State Credit Union Supervisors, American Financial Services Association, Toyota, and Financial Services Roundtable. Without objection, all members will have 5 legislative days within which to submit written questions to the Chair, which will be forwarded to the witnesses. I ask our witnesses to reply as promptly as you can. Without objections, all members will have 5 legislative days within which to submit extraneous materials to the Chair for inclusion in the record. Without objection, first of all, I would like to thank everybody. Thank you for your patience. And with that, I will declare this hearing adjourned, and I'm going to run to my vote. Thank you.